It looks like we are good to go. Hello, everybody. All right, we're getting started a little bit earlier today than we have recently, or ever, really. I don't think we've ever had a live broadcast this early. So, gosh, that's...
But we're in a hurry to bring you some really exciting stuff we figured.
Yeah.
In fact, we figured this out right after we got off the presentation yesterday.
Yeah. And Gordon's a little bit more of a morning person than I am, so he's going to be a little bit faster, you know, with the neurons firing and everything than I am today. But we did figure something out yesterday after we got off the broadcast. So if you were here for the live broadcast yesterday, you were here for our very brief conversation about volatility and some other things. And I had mentioned to him that we were going to have a conversation after. Well, actually, he stayed for another 2 hours. Yeah, it was like
Something
2
like that.
hours.
Yeah.
And we were building an indicator and looking at all kinds of cool stuff. And we're going to start with that this morning. We'll move on to the next step and the step-by-step method afterward. But for right now, we're going to move over to this really cool, brand new indicator that we just built. And it's based on, you know what? I can't even tell you what it's based on because it was your idea. And yeah, let's just move over to the chart, man.
So this is an excellent example. This whole thing is an excellent example of why you want to show up here and watch Wes and I go through stuff, because I have actually been thinking about this indicator for close to a decade and not really been able to figure out how to express it or articulate it into a programming language that could be put on a chart. I was trying to explain to Wes, and so in the middle of our conversation yesterday, I was trying to explain to him, you know, that cuts to something that I've seen before, and I really think is applicable across stocks and Forex markets in various ways, but I didn't necessarily have a way to do it. And I explained to him, well, this is what I'm trying to do. He says, I could do that for you right now.
Yeah.
So he whips out the code, and it came out even better than I imagined. And then I did some research after we set this up and realized just how useful this is going to be, because there's a dynamic that happens in the markets. And basically what happens is some group of somebodies make a decision that they don't want to be in a position anymore. Now that doesn't matter what financial instrument we're talking about. They just say, you know, it's overvalued. It's not a good idea, whatever. And it's not usually just one. It's usually a collection of people that all make this decision at the same time. And when they depart from that idea, then it creates a sort of oversupply of inventory of you know, people that want to sell. And the number of people that happen to want to buy at that moment get overwhelmed. So the price drops rapidly and volatility spikes. What happens then is once that volatility is over, then you have probably gone too far, because the market is terrible at knowing precisely where to go at any given moment. It's great about predicting where things should be 6 months out, but where things should be right at the given moment, that's why you get bubbles. That's why you get crashes. You know, it's too much too fast because everybody makes the decision at the same time. So if you can track volatility in a way, you know, there's the average true range, which I've used and always wanted to use. But then I got to thinking, well, what if we just really simplified it? Because the problem with the average true range is if the price changes, if you get a $2 stock that goes to $200 a share, then $10 a day move looks a lot more volatile on an average true range graph than you know, 10 cents a day. And so you're not really getting a clear picture of volatility. So I said, well, let's make it a function of the percentage of the price, of the most, you know, recent closing price, as opposed to, you know, so that way 2, 10, 20, 50, 100, doesn't matter. Average true range is being measured the same way. Historical volatility is being measured the same way. When we line it up this way, it looks amazingly similar to the VIX, right?
Yeah.
But with some important differences. And what's fabulous about that is the VIX is a calculation based on option prices and the option market player's best guess of how much risk there is in a particular, well, in the case of the VIX, it's the S&P 500 index. The Chicago Board of Options actually has non-public VIX-like indicators that they're working on, they're going to bring out, but they spend 2 or 3 years working on them, right? We don't spend 2 or 3 years working. We spend a couple hours, then we show you stuff. Now, maybe it's junk, but actually it has been years. It's been years of myself watching and thinking through things, talking to other experts, and distilling these ideas, and then knowing how to apply them, then coming across a guy that can whip it onto a chart really quick. So that's what this is all about. That's why this is so exciting. Let's take you to a chart and show you what this really tells us. First, I'm going to show you the end of the story. Then I'm going to back up and go through it. So right now we're looking at 3M, and 3M is a fabulous opportunity somewhere close to right now. Maybe not right this minute, but within the next few days, I am betting that 3M is going to be a good trade. Here's the indicator that we built, the average true range based on percentage instead of actual numbers. And here's the price. Now it doesn't look too interesting or too amazing just yet, but let's do a couple of things and show you why this is so important. First, we're going to go back to the S&P 500, and we're going to show you what's going on with the S&P. Notice what's happened here. This is the average of all 5 stocks, right? Oh, and you know, I probably don't need to do this, but I'm just going to show you how fun this is. We're going to compare the VIX. If you wouldn't mind just typing in VIX.
Yep.
And index, there it is. Okay. And we'll have to use our imaginations a little bit, but you see what's going on here? This is the percent normalized ATR, and this is the VIX. See how similar they look? They look really very similar with some important differences. Here's an important difference right here. Notice this one didn't spike very high, and this one spiked a lot higher. However, average true range, this one just spiked a little bit, right? And yet this one was kind of at a high level. So you know, those are an example of some differences. Here's one where it spiked up. This one spiked up, and the VIX came down, but the average true range did not. The historical volatility held while the implied volatility dropped. And why is that important? Well, because the volatility wasn't done yet, right? So you wait until the volatility is done. There's the final spike, and there's your entry point post that peak. So you know, not this one right here, but you know, you want the volatility to completely be done. Anyway, so there's some subtle differences. So maybe we can remove the VIX now. Just delete that out. Yeah. And now here's what I want to show you. Whenever you get a situation, kind of like we are seeing here, I'm going to draw a line. I was going to draw a regression channel, but it gets a little overcomplicated. Just draw a simple line here. And right about there. Okay, see, previous peak, recent trough, breaking of that trough. This particular dynamic is useful, in my opinion. I think we saw another example of it back here, for instance. Right here's the peak, or the trough. Then there's the peak that follows it, and notice what this is. That's a little bit of a short-term high. I mean, they're smaller relative to everything else, but see, this is the opposite. This is the trough followed by the peak. So what should that be? That should be a high. If in fact you go the other way around, a peak followed by a trough, what should we have but a potential buy signal? So you know, we're right in there. Notice the volatility goes shooting up higher, right? So is that our buy signal? Well, it turns out no, it's not. Where's the real buy signal? The real buy signal comes when we break this peak right here. And that, since then, has been this you know, rather strong move up. That's our May the 4th. Now we called this day on the markets, Wes and I, and said this, you know, it was going to be at the very latest on that day, the markets were going to make a decision. They were either going to go down or go up, and we felt that they were more likely to go up. Gave our reasons why. We lucked out in the sense that, you know, we look like geniuses right now. Things have been going up. But is this all there is? I mean, is this just a, you know, that was it, quick move, all done? So I took a look at the 22 most influential stocks with this lens. And of all the stocks on the list, you know, we're looking for those that sort of have that dynamic, but that they've just broken their most recent lows. GE is an interesting one. Here you've got the break, plus you've got an inverted head and shoulders. We talked about GE before. GE might really be a big opportunity, but I think that the bigger opportunity right now is probably going to be 3M. And you know, part of that is the fact that 3M's had this big downward move, and people have been in a hurry to get out. Look at those huge candles, right? 3M is part of the Dow. It's part of the S&P 500. It's this heavily traded stock. It's a very successful company that's been going up for, well, I mean, look what it's done in the past year, a 50% rise, right? So a blue chip stock that's had a 50% rise in the past year, and now all of a sudden getting shaken out like this, trading on average, millions of shares a day. Let's see exactly how many millions. On average, we're at 2 and 3 million shares a day. So a lot of liquidity there. You cannot move this stock this way, these huge volatile moves, without institutional activity. So this is like 10 million shares day after earnings. Earnings came out with an extremely negative surprise. The $2.40 estimate of earnings turned into 98 cents, and that was really disappointing for people. That was the second surprise in a row. So you can only imagine things are really bad, right? When institutions all say, you know what, we don't care, just get us out now, and they just dump the shares on the market, and people just furiously get out of their shares, like they did here, right? Why would they do that? I'll tell you, if they bought right up here, they're not doing that. They'd have to be extremely disciplined traders. And contrary to most people's imaginations, the institutional traders are not all extremely disciplined traders, or investors for that matter. They follow methodologies, great, and to the extent that they're automated, even better, then they're disciplined. But there's just a lot less disciplining going on there than you might think. I mean, here's what happens. They look at their balance sheet and they say, hey, if I bought this thing down here, I don't care if I get out here or here. Either way, I look good, right? They've got a lot of profit. They've been holding this stock for more than a year. Anybody that's been holding 3M for more than a year has more than a 50% gain, likely, or something close to that, by the time they hit this peak. So they got 50%, and they're thinking, man, I can give 10% on you know, if I can't get out now, they're like, well, we'll wait. We'll see if it comes back. Oh, see, aren't we so smart for waiting? Oh, man, that was a dumb idea. We need to get out now. And then they hurry and they get out, right? And at this point, they're like, yeah, so 257 and 225, you know, $30, whatever, 15% off of the top. I had 50% going into it, and I get 35%. I still look like a genius to my index and to my benchmark and so forth. So, you know, nobody minds panicking on the way out if they've got a big gain they're sitting on. What they're really afraid of is losing most of what's left of that big gain. And at some point, however, then it's not worth bailing on. So here, 258, you know, at the top, but now 191. If you got in the stock back here at around 181, 191, that's 5%. Why panic and sell now? It's going to be a loser. It's going to be a loser. You may as well hope and hold on, and that's what happens. Is that the people get that kind of mentality. So when things rush down like this, then they've sold too much, they've sold too fast, and it's possible that you know, the problems aren't really that bad. Now it could be that 3M's just cratering, is about to go out of business, and all that sort of stuff. Yeah. Well, if that's the case, then you know, then all of this is warranted. Everybody should be panicking, and it's not going to turn around. And we don't know the future. We could check the options prices. In fact, I did. The option volatility on 3M is only 20%, which means that the option market is not pricing in bankruptcy as an option at all. If the option market is pricing in about a $40 drop over the next month, very worst case. No, not $40 because, well, 200. Yeah. $40 worst case scenario. So really bad. It keeps going. It's going to land down in here. Well, no, that's actually not true. That's $40 on an annualized. So you take about a fifth of that. So it's more like an $8 move. So the options price actually has an $8 move. That's right, about an $8 move for the next month. So the options pricing are only pricing in the risk of it coming down to here over the next month, which is kind of stunning to me considering it's done all of this. But that also fits with this. The historic volatility has been dropping rapidly. Now, how quickly 3M is moving around is very unusual. Normally 3M moves down here like this, and that's where the option pricing is going. So option sellers don't think that 3M is about to, continuing crash and crater. And they're right 70% of the time. 70% of the time. They make a business by being right 70% of the time. When they're wrong, they lose a ton, and they have to manage that risk. But being right 70% of the time, getting a little bit, that theta decay, selling the lottery ticket, that's their business. All right, so if they're coming along here and saying, we're selling on low volatility, we can make that bet with them. In fact, we can look at this historical volatility drop, how it's taken out the lows, and say, that's it. This is our opportunity. See, there are other stocks like, let's go to Facebook really quick. See, Facebook is about to do this too, but look where Facebook is. Facebook has already had the drop, and right from the peak, they started recovering, and they did so rapidly, and they came right back up to the top. Now, is Facebook a good buy from here? Well, it might be, but that's not the kind of, we're not just looking for this, break a new high and, head higher. We're looking for this rapid spring back, these really quick moves. And these things kind of happen after volatility has already shaken out a little, see, taken out the old highs, and then you're poised to get back going again. And you're going to rise back up to the old highs. So that's the kind of chart we're looking for. And if you go down through these, there's a lot of these that have opportunities. See, here's Dow DuPont, double bottom in a short term, and they just broke their high volatility range. Real good opportunity here. You go through this list of the 20 most influential stocks, and about half of them have some kind of pattern like this. Well, no big surprise, the S&P itself as an average has that. But the best one of them, in my opinion, appears to be 3M, because we're looking at, okay, so that's weird. Why is that sitting there? I do not know. You mind deleting that artifact? Yeah. So the reason I'm interested in it is that it has just barely broken, but it hasn't really made its turn of the downtrend. The reality is, if this thing gets going, it's going to rise rapidly. It's going to rise through this gap, at least back to here. So we could be looking at the opportunity of going from 200 to 220 with the risk of it going from 200 or 199 down to about 191. So we've got about a 2-to-1 risk just to get started. Now, if things really kind of work out, then it could make itself all the way back up here, probably inside of a 1.25. And I mean, that would be a fabulous, fabulous move. I was watching a group of newsletter advisors the other day, and I respect these guys. And one of them was saying that very long term, he noticed that when you have this huge volatility increase in a stock that gets oversold, if you're able to buy on the dip over the next year afterwards, you tend to get triple-digit gains on average. 100% returns. Isn't that amazing? That's not the kind of time frame I'm looking at, buying this and holding on for a year. But could you imagine if this thing went to $400 a share from here? What a genius you'd feel like. But the percentage increase, they noted, was the fastest in the early part. And that's what I'm interested in capturing. That quick move that's going to happen in those first 90 days. And we've seen this happen before on 3M. Things get oversold. Look at this right here. See, this big move comes up, then it sells off, and then we come right back up and go higher. It's like, what are these people thinking? Why were they selling right here? Well, probably because earnings came in, well, 1 penny good, and then they had a dollar dividend, and then the earnings were 1 penny a surprise. So I don't even know just by the quick look, what it was that was right here, October 2016. Oh, that was that was the election, right? Pre-election. Yeah. So stocks were drifting down right through the election, afraid that Trump would win, and then when he won, they came right back, right? So this kind of stuff happens all the time. People get a little nervous about something, they change their mind, they're not nervous about it anymore, and then rapidly the stock rises. Well, there's lots of good reason. These earnings reports were terrible on 3M. Lots of good reason. Are we done? Don't know. But here's a good place to take a risk, because if we're right that it is done, this will rapidly rise. So far, there isn't any indication of a rapid rise. Yeah, there's that. You can see that alone is interesting, because here people freaked out about the earnings, and then they bought them almost all the way back up, and yet somewhere in here, institutional sellers are still trying to unload their shopping cart of this stock. And at some point, it's going to slow down. And we'll be able to see some divergences and so forth as well once it makes a bottom, and that bottom might come in lower. So I'm not interested in trying to take a position yet. In fact, I would love it if it came down here to about 195 and we saw this volatility continue to decline. Then you'd be like, okay, that's it. That's the, now I can take a $4 per share risk and look for a $20 upside. Nice 5-to-1 turnaround. So you're going to want to keep an eye on 3M. This is not a recommendation to buy. This is only an educational layout of what's going on. So just FYI. Now, this whole idea, this volatility thing, gets even more interesting if we start applying it to currencies. Because with currencies, you don't have these little earnings notes. You've got just the continuous flow of price changes. And for that, I'm going to actually go over to...
don't sign me up. Go to log in at the top. There you go.
Thank you. Wow. Don't want to sign you up for a new account.
Yeah, I'm okay with my current account.
All right. So let me just change this to... I actually just load the same one, and that should bring up, pound CAD with all the settings. So let's have a look at the currency. I don't know if you want to look at the pound CAD or if you want to look at some other. In fact, why don't we go to the euro dollar first, because this one is kind of our benchmark for everything, and then we can check other currencies. What we noticed is that this indicator it isn't so much its actual level. It's all about relative levels. And whenever you have these sort of relative moves that do stuff, then you want to pay attention to those markers. We just go to a daily chart here for the euro dollar to sort of help people kind of figure out what's what we're seeing and why we're seeing it. And then we'll go into shorter time frames, because there's so many more opportunities there. So the line in the middle, the thick line in the middle, is the ATR percentage base. And this is really interesting if you apply this to a currency, because it's a percentage of the price of the currency. So you have to do some stuff with the yen. We're not going to show you yen pairs here because the yen comes up with some crazy other numbers. But what we did here is we applied a Keltner channel. Now, a Keltner channel is interesting because it applies the average true range on the indicator you're looking at. So how much is this ATR changing day by day? What is the average true range of that change, and what is the range, the envelope range of those averages? And so we applied a 5-day, 5 times ATR, because this is just close to close on a currency. So it's not the whole range of the currency itself. It's just the range of the ATR percentage-based indicator. Anyway, what we're looking for is how it's relative to everything else that's going on. How much is the volatility changing? Now, when the volatility comes down and gets really low and touches these edges, or it gets really high and touches these edges, it tends to indicate things. So notice here we've got a touch of the low, and if we notice that touch of the low happens to occur after a significant downward move, then we can recognize that these are opportunities. As it turns out here, we had volatility going up, then we decreased, the volatility came down, the volatility hit a unusually statistical low point. Notice it did it back here too. And then what happens right after that? Boom, up we go. Boom, up we go. And this one here is kind of a secondary, it's like we rise, hit the secondary, boom, right? And so then here we're saying, okay, this is super high volatility, unusual, right? Which means, watch out, this is probably going to begin to decrease in volatility soon, therefore not continue going on. Well, it did go on further, but notice that this is the range, starting right here and then ending there. That is the range at which we started going sideways. We pull away from our extremes. We never actually touch the extremes all the way through here, and no surprise, we're in a sideways move. Now the interesting thing that happens is that we make this touch right here. We're going back and forth, and we get into this extreme low level of volatility. And now back here, you see that was an indication of a buy. So we would look here and say, okay, is this an indication of a buy? No, it's not. Why? Because we're not in a prevailing uptrend. We're in a prevailing sideways trend. So we have to keep an eye out for where we're going. What is the actual move? On this candle right here, what is the move that occurs right after this low volatility moment? The first thing coming out of it was this downward move. Could it be that this is a foreshadowing of all this to come? Can't say for sure. We haven't done enough testing, but it's worth keeping an eye out for. See, because what you could do is you could say this is an inflection point. We've been in a mid-range for a while. We've been in a range for a while. And now we hit a low, relatively low point of volatility right here. So from this point, we're probably going to be making a decision. It would have been simple enough then for us to just say, take the support of where we've been, take the resistance on where we've been, and in fact, let's just mark that in so you can see what I'm talking about. We could take the extremes, or we could take these, because there's actually 3 touch points right there, right? And we could also draw the resistance. We could take the extremes, or we could take these resistances right here, because we're not trying to find out what is definitive resistance. We're trying to find out what is the place where a change will manifest itself. Where will the trend really move? Once we break out of this sideways, how are we going to know which direction we're going? Because keep in mind, we're right here on this one, or one of these 2 days. We're thinking, okay, big inflection coming up. What are our chances? Well, if these are our lines of demarcation where we say we're going to, whichever one we close on the other side of first, that's probably a new trend, right? Well, there it comes. First off, we're closer to the bottom anyway, so we suspect short. But this is so typical of the currency markets. Down we go, retracement against our position, and even making a new high, scare you out, right? Stop you out of anything you would have tried to trade, until finally it makes the decision. And once it does, wow, big move, really big move, right? Now, how about that move? Notice here, low volatility, but once the move starts, the volatility increases. See how that's trending up. As long as it remains trending up, that's still heading down and in that downward trend. We will know that trend is probably done when we see this thing either hit the bottom or change its slope, or both. So that's the kind of thing that you can be looking for in currencies. This sort of relative move, right? So let's look at the what's a currency you want to pick. Let's go to 240 minute on a chart we haven't looked at before.
Chart that we haven't looked at before. How about the? Let's try the Australian dollar, New Zealand dollar.
Yeah, there we go. Aussie Kiwi. Nice. All right. We'll go 240 minutes. Let's see if we can find trading signals that would be meaningful here. I'm going to actually zoom in so we can see it really close. You know now kind of what we're looking for and how we're looking for it. I'm going to give the mouse to you, Wes. I'll jump in and say stuff if I need to, but see what you can see here, and tell me if you are seeing, based on the way we were looking at with this indicator yesterday, what jumps out at you?
Well, let's see. Actually, I'd like to go back to the beginning.
Oh, okay. The end.
Yeah, the end. Yeah. I consider this the beginning. The beginning is right now, and the end would be way back in time. I don't know. Depends on which version of Back to the Future we're in.
Yeah, right. Okay.
Yeah. So, all right. We've got a lower volatility movement right here relative to the ATR. So it moved down past the regular ATR.
So this chart, let's notice the time here. That's set for what? Is that UTC or is that Eastern time? Oh, there it is. UTC.
That's
so
us.
Eastern time.
No, -6 is us. Mountain time.
Okay, Mountain time.
Yeah.
All right. So this time frame, these low volatilities, like that one right there, notice that that's at 1900. That's 7 p.m. our time. That's about the Australia, New Zealand, right before the open, right?
No, the open for the Australian session I thought was the same time as the close for ours. Actually, you know what? I have that right here, FX hours. Look at that. So Sydney is, 3 p.m.
3 p.m. So 7 means it's already been open 4 hours.
Yeah.
Okay, that's interesting. I just wanted to keep track of that because basically, when are we going to get those low volatility things? We want to make sure that is. I mean, that's kind of a dead time for all the other markets too, right? I mean, that's nighttime U.S. and early morning hours Europe. Neither of those major market areas have opened, so it makes sense that would be a low volatility bar. And so I think you kind of have to, when you're looking at a 240-minute chart, 4-hour chart, you've got to sort of take that into account. It can still give us potentially meaningful signals, but I'm just noticing several touches along the way that probably correspond to that same time frame.
Well, it does actually, 1900 and then another 1900 right there.
Yeah.
But what I was thinking was, if we look at this, we've got slightly higher volatility here. Actually, we have extreme volatility here on an upward movement, and then we come back down, and we still have higher volatility than we've had previously.
Right.
But the volatility is decreasing over time as price is increasing over time. And then finally, we hit down here at this, I don't know, we can call it a normalized level because that's kind of an average of where we've been seeing volatility spend most of its time.
Yeah.
And but once it gets down here and touches this one more time, now we've got this sideways move in the market. Volatility is going up as we've got all this choppy stuff going on in this channel. And
you're thinking that is like, in other words, if somehow you got to participate in that move anywhere along the way, once you see this probably be right there after the 15.
Yeah, people
as we've kind of trended up, that would be telling you, don't expect much more out of this trend.
Right, and because people are getting out now. Like, it moved really rapidly for whatever reason this was. In fact, you know what? I actually remember what this was. This was, this may have been, I think this was the New Zealand dollar interest rate decision.
Is that right?
Yeah, okay. It came out to be exactly the same as it was before, but they were expecting it to be lower. I don't remember what it was, but
expecting a change.
They were expecting a change, but it went unchanged. So the Australian dollar actually rocketed up. But that was more of an inorganic move. It wasn't really, hey, the entire economy of both of these countries has changed now. It's more like we had this big
expectations.
Move. Everyone got into the Australian dollar, but now we've started to level off and people are getting back out. Institutions are getting out. Whatever else, whoever it is that's trading these particular currencies, they're going to be normalizing again, and whether that means coming all the way back down and meeting the same price that we were at and following the same trend, I have no idea. But it does seem like this inorganic move right here caused a very rapid movement upward as people were trying to get in on the same move. So when we started moving up, then people started, this was probably a whole bunch of people stopping out, and then more people were getting in. And now we've got people who are just getting out. So we get out, and then a few more people get back in because they find it's a bargain price. So they get back in, and then it goes up just a little bit. More people get out, and then another bargain price move up. and now we've come back down again. And
Yeah.
but we keep coming down to the same price. It keeps trying to jump higher, but it just can't. It hasn't been able to really produce the same significant move that it had before. So now we've kind of hit this leveled out spot here.
Yeah.
And volatility is, well, volatility is relatively staying the same. It's not really doing much, but it is rising a little bit as we're seeing more and more of this choppy movement. So we're probably going to see more choppy movement. What is this? Retail sales for New Zealand.
Coming up, huh?
Yeah, it's coming up today, I guess, right? Isn't that today? What is that, 5:20? No, that would be Sunday.
Okay.
Yeah.
Oh, market open next week. Okay.
Yeah. Anyways, that's just what I'm seeing with the
Yeah.
with the volatility stuff. We saw a huge volatility spike, and then volatility immediately started to drop again. And even though volatility was still higher than it usually was, or than it has been in the past, volatility was still dropping, and we saw the price moving upward very slowly.
Right.
And now volatility is starting to rise again as we're seeing all these downward type movements. People are getting out of it.
Yeah.
So.
Well, go back, like just scroll back several pages here, and yeah. So right in here, let's have a look at this. See these big moves up and down, right?
Yeah.
Are they relatively big moves, or is it just the price scale?
They're relatively big moves. I mean, this is a 240-minute chart.
Yeah.
These are,
All right.
these are decent-sized moves.
So right there on the 24th, let's look at that one. See, this is similar to what we just experienced, or what we saw from that rate decision, right? I mean, who knows? There's probably another rate decision. So the volatility screams up, and this is going to be typical. Let's zoom into this area here a little, and this is going to be typical of any currency that has a rate decision associated with it. This takes off, and then notice that it doesn't keep pushing against the top, right?
Oop.
It's through this area down here, the volatility just flattens, holds at that new level, but flattens as the price continues to go up. That should be forecasting to you that this trend doesn't have long to go, because the volatility that got it started isn't continuing to trend higher. It's tapered off. And then notice the next volatility peak is going the other way. That should be a huge indicator. Got to get lost. For lots of technical reasons, big bar down,
Right.
But what you don't know about that bar is it going to whip right around and go back up? Well, in this case, I think it's really easy for us to be able to say, no, it's not. It's going to continue going down. Would anybody know that it was going to be huge down like that? I'm not sure. I'm not sure that this volatility could tell you it was going to be that bad.
Maybe it couldn't tell you that it would be that bad, but if you keep following this along, and this is the thing that we've been looking at, or that at least I've been looking at, especially with currencies, is if you follow it along, you see you've got this big move that just barely pierced the top, and it was a sell, it was a bearish candle.
Yeah.
And then we move right along, it starts to taper back off again. And then we have another one that brings us up to the exact same point, almost, with another bearish candle.
Yeah.
And then it goes up, and then it goes down, and it goes back up, and we have this big bullish candle again with the higher volatility again, and the volatility just starts to taper back off again. I mean, the volatility went up as the market was going down, and so
Right.
I mean, it's more indications that this was the same as this, and this is the same as this. So we should be expecting more movement downward, and we do.
So then how? Yeah. Keep following this down. This trend gets lower and lower and lower, all the way down until an apparent bottom right here. See, now you would think that because it was down here, all of a sudden the volatility should be decreased, or maybe the volatility would be at a very high point and it should be decreased, and should give us the signal that somehow this is the bottom, and up we go. And that's the tricky part about all this, is that in currency world, stocks, it's a little more regular, and you can get those kind of signals, kind of like we were talking about. But in currency world, it's a little less obvious, especially if we're on a 240-minute chart. So here's what I would want to point out right here. Notice that from the 21st through the 9th, we've got a sort of range of the volatility. Our band is going up and down, But bigger picture, you see what I'm talking about? That sort of channel of
Yeah.
high and low. Draw a couple lines on there, and you can sort of see what that channel is. We can let people visualize this channel that I'm imagining. Yeah, there we go. See, so through this period of time, the volatility has settled in, right? We're still trending down, but at a regular rate. Notice what happens right when we break that rate. Notice how also, you see how the price action is sort of, wedging smaller and smaller like that? Yeah, you're on to me. Okay.
Let's see.
Yeah, from this one.
Yeah.
See, and that wedge formation is roughly equivalent to that channel that I'm talking about where the volatility is kind of holding on. You wouldn't notice this at the beginning, but as you notice the wedge pattern apparent, become apparent, then you go looking and say, is there in fact a volatility channel? And are we about to make a change in that volatility channel? Now, we could have just as easily spiked up to a new level of volatility there when we completed this channel. It doesn't really matter which way we break out. The fact that we change the volatility means we can expect that there will be a substantial tradable change in price. In this case, we've been going on a downward trend, so when we break that downward sloping resistance, I mean, it's all too easy to expect that it could be going up. What does the volatility add? Well, the volatility is an important confirmation that says, hey, this thing isn't just going to squeak out of there and make a fake out. This is a legit longer term change in volatility, and I mean that's a fabulously tradable signal that you'd want to be part of. So I kind of think that this volatility study, especially in conjunction with the price patterns, because this is what we're talking about with 3M too. It had already fallen back. We weren't interested in the Facebook trade where it had come back and yeah, volatility is dropping. Sure, it might continue to go up, but we want that rapid snap that happens as a result of somebody overcorrecting, overselling, getting emotional, getting irrational somehow, and then we get that sort of snapback plus the potential for a new trend. So these are examples of ways this can be used. So how should we make this indicator available, Wes, to anybody who wants to use it? Do we have a way of doing that?
Yeah, we sure do. We can. It's available at the moment for invite only. So our Trader Continuum members, anyone who's on the Trader Continuum can request access, and we can give you access immediately.
Let's do it that way. But since it's so much in beta mode, let's not make this part of our paid subscription just yet. But let's give it out to anybody that wants it. So what would they have to do? Just send a chat or an email and request it, and then they have to have a TradingView account.
Yeah,
right?
you have to have a TradingView account in order to do it. So you would send us your username for TradingView, and we can get you set up in the invite-only part of this. In fact, we could just make it public, and then anyone who wants to use it can just use it, and then just look it up. That's even easier.
Yeah, I kind of want to work with it and refine it a little bit before we go there. So I think we will, but let's look at getting it the best, and we'd love to have people, anybody who's watching this and feels like, hey, I want to play around with that and see how it works, and give my feedback to it, then send an email with your TradingView username, and then we'll add you to the invite, and that way, while we're sort of going through it, we can work with you, give you feedback back and forth over email as you like. So how would they send, what email would they send it to?
You can send it to technical.markets@gmail.com, or just reply to any email that you've seen come from us. Because if you're watching this video, odds are you've received at least one email from us. So if you just look it up, Trader Continuum in your inbox, and just reply to anything that we've sent you, and it'll come right to us.
So you want the indicator, and here's your TradingView username, assuming you have one. It's free to sign up if you don't have an account yet, go sign up for a TradingView account, and then send us your username, and you can get this indicator. It's really, we're going to refine it, but I got to tell you, this is super exciting, because basically what it does is it allows you to put the equivalent, or close enough of the equivalent of the VIX on any instrument. And the nice thing about that is you can get a sense of what, so people might not be watching this precise indicator, but I guarantee you, institutional investors are watching a number of metrics which give them the equivalent of this information. And the reason for that is they have to watch their risk. They have to know their overnight risk. They have to calculate how much money they could lose if everything goes south in the next 60 minutes. And they don't. That is the part they're extremely disciplined about. They don't allow their account to blow up just because something weird happened. And so they allocate and make sure that they control their risk through those allocations. And when all of a sudden something changes, especially in the currency world, because they don't have any sort of hard and fast, econometric spreadsheet models that can really give them, here's where the price of this currency should be. I mean, they have people to do that, but it's the currency market. Everything is a guess, and so they're acting on price levels. Well, if the price moves this far, this fast, then we have to do something, and that's volatility. And so volatility is actually acted on, and I believe that this indicator, studied well, observed well, we'll be able to recognize what are the action points that people are institutions are working on, and we'll be able to find value in recognizing some of those signals with this indicator.
I agree, 100%.
All right.
Yeah, so we'll be refining this further over time, probably even after this live broadcast is over, but we'll also be refining it over the next several weeks, and Gordon already has access to it, so I imagine Gordon staying up last night till like 1 a.m., like just fiddling with this indicator, thinking, oh my gosh, what if I do this? Oh my gosh, look at this. He geeked out pretty bad with it yesterday. It was that's why we were here for like 2 hours afterward. It was pretty awesome.
There is a lot of potential here, and we're going to be finding ways to increase the utility of that in a number of ways that we'll be putting as part of the subscription. But so that we can capture it, do you think it'd be all right to go to step 4 here in the time we have left?
Yes. Actually, I'd like to bring up one last thing, which is that today is the last day to subscribe to the Trader Continuum at the early registration price, which is $49 a month. So if you don't subscribe today, then after today it goes up to $99 a month, because the first term has already started. So our terms are divided up in periods of time that we are using the step-by-step method to determine the best fit and the best educational movement for the people who have signed up already. So we've already started that this week, and as of right now, it's not too hard to catch up, because we've only had a couple of members-only webinars. But after today, then the price goes up, because then there's a whole bunch of catch-up that you have to play and all that other stuff. And due to the number of people who have already subscribed, that just has to happen. So anyways, today's the last day for the early registration price, $49 a month. And now we can move on to the step-by-step.
All right,
step 4.
excellent.
Sorry. All right.
Bring that up. So the final step, we're talking about STEP, right? And so it's an acronym that we came up with to sort of help you recognize. And the final piece of this acronym is actually what you do once you've proven you have a system that works. We talked initially about each one of these steps. So let's just review really quick where we've gone through and what we're looking at right now. The first one is to seek out and learn strategies. Find ones that fit you, that fit the time frame you're trying to trade in, the kind of volatility you're comfortable with working on, and things like that. So are we on the slide yet?
Yep. Oh, no, we're not showing the slide yet. Ah, weird. All right, let me fix that then.
Okay.
There we go. All right.
All right, so here we are. We're looking at seek, I don't need to do it that way. Seek and learn the strategies, find the ones that fit you, try out the strategies, engage them with your money. We covered that yesterday. And then we're going to promote the strategy to an algorithm to automate your work. That's the step we're going to talk about today here for the next few minutes. There's not a lot to this here, but there are some important tools and things you need to understand. We talked yesterday about how to model your system and showed you the spreadsheet that we're going to make available to subscribers to help you use that. But then, once you've proven that you've got a system, and you get in there and you actually engage your money and you trade it and you think, wow, this worked out just like I modeled it, great. You would now ask yourself the question, do I like doing this? Do I like actually making trades, following these rules precisely, exactly? If I do, that's cool. I get to do lots more of it by automatically following my rules. No problem, happiness. But if I don't, then what could I do? Well, what you really should do is build or use an existing trading robot, right? Either way, you have to follow your rules concretely. And sometimes the best way to do that is to have a computer trade for you. Either way, as you do that or you have a computer do it, evaluate your results. Ray Dalio, the most successful hedge fund manager in the world, said, there were days that I wanted to just go hug our servers because they did such a wonderful job of keeping us in trades or getting us out of trades when our emotions would have had us doing the opposite. But the computers had no emotions. They stayed up all night working and didn't get paid. We just fed them electricity, and that's all it took. And it was kind of a funny way to describe it, but that's exactly the value that you experience when you're using automated computer-driven trading system. There is a reason that 75%, it's true, 75% of the Forex market is traded algorithmically, meaning somebody else used a computer not just to click the buy button, but they used a computer for the computer algorithm to turn around and send the buy order. If you're sitting at home and you're going, I think I want to buy right at this pip level, and one mini lot, please. Thank you very much. Click buy. In the amount of time it took you to move your hand from wherever it was to the mouse button and depress the mouse button, or even from the amount of time the thought occurred in your head, the neurons fired, and the nerves impulses signaled for your finger to make that millimeter distance to make the mouse button depress one click on the buy button, right? That amount of time, dozens of orders went by you in the Forex market, maybe hundreds, and they're all happening instantaneously. In fact, in between those two times, it's quite possible that some computer algorithm out there both bought and sold, making a profit for itself, right? Now that profit might have been hundreds of a pip, but that's the kind of thing that is going on in this market. You're literally stepping onto a pack of floating ice or a sea of shifting sands, whatever you want to call it. You cannot imagine for a second that you have any kind of advantage as an individual trader. You have to be extremely rigorous about your trading rules in order for you to make sure that as a manual trader, you're going to have an edge. If you have a computer trading for you, then all of that variability goes out. Of course, maybe you've got a horrible system and you've taken out all the variability of a horrible system, so you can very much guarantee that you're going to lose your money. But
that's the best kind of system.
Yeah, right. It is the best kind if you trade the opposite side of it, right? So what you really want to do here is make sure that you have evaluated your results, whether you're trading them by yourself or, oh, I went the wrong way the first time. Okay. Whether you've evaluated your own trading or you have evaluated your computer's trading, which should be your trading just super disciplined, then you have to evaluate, make sure it's worth your time as you thought it should be by now. And then you measure the correlation of your programmed systems. This is the really fun part. Most people don't graduate to this level. But if you have multiple programs running, 2 or 3 different programs that are pulling in opportunities, imagine being able to grab some of those volatility plays that are going to be apparent from these things off of a robot while you're sleeping, right? You're not staying up all night to watch the Aussie Kiwi, or if you're in Australia or New Zealand, you're not staying up all night to watch the US markets do its thing, right? But there are all sorts of crazy volatility plays that can happen. You can get in, you can get out in a matter of 15 minutes and make a significant profit on a 20 pip move, for example. And imagine your program system could grab all those for you while your other program system is in a longer term swing trade and just carefully picking off a larger trend, right? If you don't like the idea of trading with a computer, but you don't trust yourself, then finally your last option is finding a trusted advisor to trade your systems, or to trade in such a way that is similar to the kind of systems you wish you could trade. So those are the sorts of things. I'm seeing our Trader Continuum link is in the way of these last bullets. I'll have to make sure I don't...
Well, give me 1 second, and I can fix that problem.
Yeah, okay. So...
there you go.
In this part of the cycle where we say we want to promote promote to the automated level, we've proven we've got a system, and now we're promoting it and we're programming it. Either one. Here's the big thing to think through. The reasons to consider using a robot are that you don't want to spend too much activity executing trades. You like trading, but you don't actually like doing the buy and the sell and the planning and all that. The computer could do that for you. If you get too emotional over trades, if you don't want to overthink the trades, this is mine. This is me right here. I just tend to I think, wow, this is a great trade. Wait, maybe it's not. I can't remember. Was this? Did I do this last time? Oh, I totally freaked myself out and psyched myself out in the middle of trade. Hate doing that, right? That's why I'm interested in an automated system for certain of my trading methodologies. And then system requires rapid reflex and performance. If it's a short-term system, if it's an intraday system, if it's the kind of thing that you feel like, boy, I got to be on the top of my game. Oh, I've got a cold today. I'm not in the mood. I know I shouldn't trade today because if I trade today, I'll lose money. If that's the kind of thing you're experiencing, then you have a system that requires rapid reflex and top performance. And those are systems that are better suited for a robot. Now, reasons not to use a robot are that you actually like executing trades. Now, that might sound silly. It's like, well, that's no indicator of success. Actually, yes, it is. Because if you like it, you'll do lots more of it. You'll get really good at it and better at it. And eventually, you'll have an edge in the market because of that. So allow yourself to do that. If, in fact, your trading is highly subjective and discretionary, then you should consider not using a robot. It's like, there's a trade. I'm going to grab that one. Why? Well, I just felt like it. Why? You did the exact opposite yesterday. Yeah, no. Yesterday was good to go short, but today is go long. I'm sure of it, right? So if that's the way you trade, that's fine. The only question you need to ask yourself is, do you get inconsistent results? Because if you do, then your trading, your highly subjective and discretionary trading may not be worth its time, and you should look very closely at that. But let's suppose that we're here at our last step, program and promote. We're not talking about stuff that doesn't work. We've already proved that it does work in our previous step. So now we're asking, we get here, we have a highly subjective and discretionary method, but it's making us money. Marty Schwartz was that kind of guy. The question is, in all of your subjectivity and discretionary movement, can you maintain a certain level of consistency? If you have good risk management, then you can. And so it's perfectly fine. But if that's what you've got, then yeah, don't use a robot. Trading rules, if your trading rules have too many exceptions to them, so much so that it's hard to program the robot. guys who were market makers on the floor of the New York Stock Exchange, Goldman Sachs came in and had their programmers say, well, how do you trade? And they started explaining it. It took the Goldman Sachs programmers 2 years to get some of those guys' trading styles, fully programmed in. Now, once they did, it was solid. And those guys now, they can go out to lunch, literally leave their post, a place where there used to be 6 or 7 guys harried all day long, scrambling, yelling, talking, writing things, typing things. They just walk away. There's nobody at the post. Computer algorithms trading away, right? That happens. And I mean, if you think, oh, New York Stock Exchange doing a terrible thing. No, don't even go there. Are you kidding? Arcanet, ICE, Intercontinental Exchange, BATS, all these networks, that's all they ever were. They don't sit there and like watch the computers all day long. They turn them on 24/7 and nobody watches them. It's just all algorithmic. So the fact that the market makers take a lunch break, you know, hey, they've got texts. Something goes wrong, they're back on the floor in a minute, and they're trading manually. So it's and even before the shut off happens, those guys are alerted. So they're, you know, the markets are not at risk of blowing up because that guy's out to lunch. That's how good the computer systems are these days, and that should tell us something, shouldn't it? If every major exchange could trade could rely on computers. Every New York Stock Exchange, NASDAQ, every one of them relies on electronic trading, so much so that people could walk away from the computers and just run. What does that say to us? Should we be afraid of trading the computers because somehow the computers are going to pick off our stops? What about those guys? They use stops. Are they getting picked off? Yeah, you bet they are. But in the long run, if you have a good strategy, getting picked off just helps you because it frees up your capital to get into another position. Yeah. So you gotta kind of think that through and recognize whether or not the trading rules that have so many exceptions, or they're highly subjective and discretionary, are they truly worth your time to continue doing? So last of all, if you have that bullet was kind of weird. In order to select a trusted advisor, then you have to track their performance. That should be not thanks, but tracks performance. Your trusted advisor should track the performance, and that trusted advisor should give you their reasons not to use a robot. Maybe they like executing trades, or maybe they have systems, right? Do they have all of these things? Do they have all of these things and have a track record? Fine. Then perhaps they can be your trusted advisor. If not, don't bother. Now, one more thing. We talked about modeling your system. I just want to show this again for each of the people that may not have seen yesterday. When you are working with a trusted advisor, see if they can give you enough data so that you can model their system. And if so, then it will give you a lot more confidence to help you work with that advisor. So if you can model their system, you can get an idea of, all right, if I give my money to this person, I have to be willing to put up with this kind of a drawdown, 15%, 20%, 25%, whatever it is. And you could say to them, here's my position size model. How are you going to follow that to make sure that I don't have any more risk? My money doesn't have more risk when you have it. So get them to either give you modeling stats or give you enough data. So, tell me, Mr. or Ms. Trusted Advisor, what is the result of your last 50 trades? And tell me them in terms of losers compared to, risk to reward ratio, losers or winners, and the risk to reward ratio. Or if you're a Van Tharp fan, that's R multiples. If they don't have any of that data, chances are they're probably not as trustable as a trusted advisor ought to be. But anyway, that's kind of just what I wanted to end up with, and so that's the final stage of promoting. As you are working with us, as we have subscribed to the Trader Continuum, we're going to help you move through each one of these levels, seeking through new learning strategies. So over the next couple of weeks, we're going to be putting out our strategies. Strategies we think that you should consider. We'll start with the 56-week pattern. We'll start with a manual version of Wes's handyman robot so that you can see what trading that would be like. We'll talk you through a couple other, this new indicator, what a system would look like there. Wes has got a fabulous indicator. We'll talk you through that system. And basically, we're going to just throw all these systems out to help you have a chance to sort of learn them. And then you can decide, hey, this is one I want to work with. I need more information about it. So great, you can email us and chat us and say, can you talk about the things I need to know to get better at this particular system? We'll do a whole day broadcast on that question if you send it in. So that'll be the first part, and we'll be focusing on that for the next several days, maybe 1 or 2 weeks, and then we'll move on to the other steps as we go. And then our specific subscription webinars are going to give detailed examples of how you follow them. Like, so here are the trades that you would put up with this system. And we'll be tracking our trade results as we go along so that over time you'll be able to have this buildup of data and say, you know what, those are the kind of results I want. I'm going to try that system out and so forth. So just to give you a little bit of preview of how, now that we've set up this whole framework, all the activity we'll be putting forward going forward from here.
Awesome. Also, on Tuesday, Scott Cook will be joining us to be trading penny stocks.
Penny stocks.
Yeah, this is going to be pretty awesome. So he'll be a regular on the show. Probably not every day, but probably once a week or so, maybe even a little bit more, depending on how often he wants to join us. And we'll probably be adding more live broadcasts to the schedule. So morning ones and afternoon ones.
We're really excited about a Monday morning program that we're going to be instituting. We don't know if definitely won't be this next Monday. We hope the Monday after, but we'll see. No details about it just yet, but when you hear the details, you're going to like it. So,
yeah. Lots of exciting stuff to come. This is the last broadcast for this week, so we'll be back on Monday at the usual time, 3:30 p.m. Eastern Time. So join us at 3:30 p.m. Eastern Time on Monday, and we'll see you then. Thanks for being here, everybody. All right. Let's see.